Hello, my name's Craig Erlam, Senior Market Analyst at OANDA. Today we're going to talk about the euro versus the US dollar. We have rebounded off the lows recently in this pair. Of course, this has been a very, very prolonged decline in this particular currency pair, driven by both factors really. The softening of the euro in conjunction with the slowdown which we have seen across the euro area, but also the fact that the dollar has remained strong for quite some time throughout this trade war. It seems that its safe haven status, the safe haven appeal of the US Treasuries, has continued to provide upside support for the greenback. But we are now starting, it seems, to potentially rebound off those lows. We came close to 110, which I think is a really important psychological level that you can see on the chart there. We fell just short of that of those levels and have since then rebounded a little higher. Again, we've seen a little bit of softness in the US dollar driving that. I don't really think we're putting this down at this stage to any form of strength or resurgence in the euro. I still think it's looking a little bit soft. Only today, Germany has contracted, or data has shown Germany contracted by 0.1% in the previous quarter. This is very much one of the side effects of the trade war between US and China, the unintended side effects, although I'm sure Trump may suggest that it's not particularly unfortunate, given that he's very much got his eye on Germany and a few other countries next. But Germany is a massive exporter. It's a massive, it's very much a massive trade advocate, and China is a very important market for it. There are other markets that have slowed as well as a result of the trade war, and this is very much taking its toll on Germany's export market. Germany's manufacturers suffering heavily. There are, of course, other things. The car industry facing difficulties as well. Again, a very important industry to Germany. And I think Brexit ultimately is starting to potentially take its toll a little bit as well, because the UK is an important market as well. So I think a number of factors are taking its toll on Germany, particularly the trade war. But the euro area as a whole, as we've seen by some of the data recently, the ZEW figures earlier this week were very much deep in, was some of the worst figures we've seen now, or the worst figures we've seen since the debt crisis back in 2011. So clearly this is not just German-centric, but Germany is the powerhouse of the euro area. So that's one of the reasons why I don't think we can really attribute this rebound we've seen in this pair to just the euro. I think we are probably seeing a bit of profit taking on the way down as we've approached those 110 levels. The question is just how far does this kind of corrective move go, given that we've seen such a prolonged downturn? Well, we're just short of 112 at this moment in time. For me, the key areas are around that kind of 113, 114 level. This is where we see the 200-day moving average coming into play. This is where we see prior levels of resistance. And as you can see, those long-term trending, descending trend lines here, they go back a couple of years. They are also coming in around these levels as well. So if we can push through kind of 113, 114, becomes the next notable level as far as I'm concerned, but 113 would be an encouraging sign. 115 above that, again, just moving another one mark higher, does then automatically provide the next level of resistance. If we can take these three out, then I think things start to look a lot more bullish, but I think this pair is going to face a lot of difficulty into those areas, and we'll very much have to rely on dollar weakness if we are going to see this pair propel through those levels, because I just don't think that there is enough there right now for the euro area itself to deliver on those gains for the single currency, especially at a time when the central bank, the ECB, is considering stimulus options.